Yesterday I explained which state gets the GST revenue. GST is a destination based consumption tax. So where the final consumer consumes the goods, that state gets the GST revenue. I'll explain with a small example. Hope there is some clarity after seeing the whole example, though it is little complicated, but try to understand that. A manufacturer in Maharashtra supplies goods to a distributor in Karnataka. The cost of the goods is 1000 rupees plus interest rate supply. So IGST is charged at 180 rupees. So the total cost is coming to 1180. In IGST portion, 50% goes to the state and 50% goes to the center. So 50% of 180 rupees, that is state share, 90 rupees goes to Karnataka, since the receiver of goods is in Karnataka. So the tax travels from Maharashtra to Karnataka. Now further, a distributor in Karnataka supplies goods to the same goods to a retailer in Tamil Nadu. He charges 1200 rupees. So there is a markup which he puts. So 1200 rupees plus 18% GST, that is 216 rupees. So 1416 rupees IGST interest rate supply he charges to the retailer in Tamil Nadu. Now in the 216 rupees which a distributor collects from the retailer in Tamil Nadu, already 180 rupees ITC has been paid. So he adjusts 180 rupees as ITC and pays a tax of a cash component of 36 rupees to the Karnataka government. Now in this 216 rupees GST, 50% of the share is to the state, 50% is to the center. So now since the receiver of goods again is in Tamil Nadu, the final receiver of the goods is in Tamil Nadu, 108 rupees will come to the Tamil Nadu government. So this 90 rupees what is paid to Karnataka government plus 36 rupees cash portion, in that 50% it is for Karnataka, 50% is for center. So 90 rupees plus 18 rupees, that is 108 rupees, travels in the back end operation, back end system it is there. So whenever the tax is paid and the goods move, the place of supply now it is in Tamil Nadu. So the tax also is been shifted from Karnataka to Tamil Nadu in the back end. 108 rupees gets transferred to Tamil Nadu. Now Tamil Nadu retailer further supplies the goods to the final consumer in Kerala. So the goods are finally consumed in Kerala. He makes a markup. Now the cost of the goods is 1500 rupees. 18% GST, 270 IGST interest rate supply. So the total cost of the goods including GST now is 1770. Now again, the retailer in Tamil Nadu, when he collects 270 rupees, he will not pay completely in cash because already 216 rupees he has paid to the distributor. So input tax credit will be available. So balance of 54 rupees only will be paid by cash. So 216 ITC adjusts and 54 rupees cash he pays. So 270 rupees is the tax which a retailer in Tamil Nadu pays. In the back end operation now, the final consumer in Kerala is in Kerala. So Kerala government gets the GST revenue. So 270 rupees, 50% share of state, 135 rupees. Finally, for this whole transaction from Maharashtra till Kerala, Kerala government gets the revenue. Again, like how it was in Karnataka, in the back end operation, Tamil Nadu share of whatever 135 rupees now will travel from Tamil Nadu to Kerala, and the Kerala government gets the final GST revenue. So it's a destination based consumption tax. So where the final consumer consumes the goods, that is in Kerala in this example, that government gets the revenue. So it is a total shift in the previous, how the previous regime worked. In the previous regime, if you see, maybe Maharashtra government for the sale, they would have got the tax, but here in this case the final consumer is getting the tax. So to understand, I request to see this example once again so that there is a clarity. Hope you like this example, and if you have any query, you can definitely ping me personally. Thank you so much.